Welcome to this presentation of What You Must Include in Every Trade Signal, Part 2. This is the Specialist Trading Weekly Stock, E-mini, and Forex lesson. Hello everyone and welcome once again. My name is Stephen Primo. I am the president and founder of Specialist Trading. And in last week's presentation we went over the 3 details you needed in order to have a successful strategy. You must have these 3 details included in each and every one of your strategies. And we're going to take it one step further with today's presentation and show you one more thing that must be included in all of your trading strategies if you want them to be successful. But before we begin, as always, I ask that you please take a moment to view our disclaimer. I'm going to show you some performance results using these things that are needed in each and every strategy. But please remember that we can in no way guarantee that any of these results will be repeated in the future. So please take a moment to view our disclaimer, and then we shall begin this week's stock, E-mini, and Forex lesson. All right, now I'd like to start off by talking a little bit about what it means to be successful, because most traders, it's been estimated that most traders will probably lose within the first 6 to 12 months of their trading career. And when we say lose, we don't just mean lose a little bit. They'll pretty much be wiped out or lose all of their trading capital. And we think it's because a lot of traders are trying to go for the home runs. They're trying to swing for the fences and really get that big score real quick and make a lot of money. We really feel that most traders have been taught that that's what it means to be successful, but at Specialist Trading, our opinion is success is not about hitting home runs. It's not about these huge payouts. It's more about consistency, being able to trade 2 steps forward, 1 step back. So really what success is, in our opinion, is consistency, being able to have that consistency in your trading so that you can be trading 10, 20, 30 years down the road. So how do we get that consistency? Well, my mentors taught me that the easiest way to do it is by keeping your trading as simple as possible. I know you've all heard it before, keep it simple, but trust me when I tell you, it really is true. The more you keep your trading as basic and as simple as possible, the more you'll be on that road to success and consistency. So, simplicity equals consistency. Keep your trading plan simple and you'll get on that road to consistency, which is ultimately success. All right, so let's review what we talked about last week. We talked about what you must have in each and every component of a trading strategy. And so this must be included in every trade signal within that strategy. And first of all, for buys, what you want to see is you want to see that price is above the 50-period simple moving average. Okay, this tells you that you have some semblance of a uptrend in place. We also want to see now that price is above, but it starts to decline or sell off towards the 50-period simple moving average. It doesn't have to touch, but as long as it sells off in that direction for a shortened period of time. And then lastly, what we want to see is that there is a price bar in that sell-off that closes in the top 25% of its range. This is giving you a clue that the sell-off or pullback, as it's known, is getting close to concluding and that we may be headed backward, upward in an upward trend. Now we just do the reverse for sells as we review here what you want included in every trade signal if you're going short. You want to see that price is below the 50-period simple moving average. And once you see that the majority of prices are below, you want to see it start to rise or bounce a little bit towards that 50-period simple moving average. And in that bounce, you want to look for a bar that closes in the, I should say, bottom 25% of its range as opposed to the top 25 where we had for buys. So this is what you want to see in each and every trade signal. This will get you on that road to consistency, and you see how simple this is. Okay, so this is what we were reviewing from last week, and we showed you some examples as we see here in Facebook. Going back to the beginning of the year, we had 4 actual signals that were generated by one of our top strategies, strategy number 4, where they followed all these rules. We sold off, we're above the 50 period, we sold off, and we have a bar here in the top 25%, and look at the rally that ensued. Then we sold off again, we have another bar here in the top 25%. We bounced up a little more, a couple more points. Then later on we went below the 50-period simple moving average. We bounced up and saw a bar here that closed in the bottom 25%, and now we sold off. So you see that this works in real time, not only in stocks, but as well if you're intraday trading the E-mini. Here's what we said, if you're day trading, we're below the 50-period simple moving average. We want to see price rally, and as we see it rally, we look for a bar that closes in the bottom 25%. And that's a good signal that we're going lower. And the same thing transfers over easily into the Forex market. So you see this in each and every market, in each and every time frame, and in each and every direction. We're well above the 50-period simple moving average. In this particular example, we don't sell off that much, but remember we said we want to see price either sell off towards the 50-period simple moving average or at least consolidate. Consolidate means to go in a range type of pattern, or to kind of go sideways. And it's the same thing where it means we're just kind of coiling and getting ready to move in a somewhat of a direction. And the clue is when we see a bar that closes in the top 25%, that's most likely a clue that the market is telling us it's going back up, which it did. Now, one of the things that we want to talk about is an entry technique. This is the next component you need to find in each and every trade signal, because it's not just enough to find these three things we talked about in the past presentation. We also have to know how to enter. Now, this is a great entry technique that you can use and apply to each and every strategy you trade. And before we get into the details, let me talk a little bit about how most people decide on how to enter into a trade. These are the reasons why most traders will enter a trade. Either they say, well, the market is too low. Okay, we're tremendously oversold, so it can't go any lower. It's got to stop here, so I'm going to buy. Or just the opposite, the market is too high. All the indicators or all the gurus are saying that it's too high. We've got a short here because it's meeting some resistance or as such, and so this is a great place to short it. Or a lot of traders just rely on what a trading guru is. They're in a trading room, a chat room. They just listen to the person there and just basically what we call piggyback riding. They just do whatever the trading guru does. If he goes long, they go long, and vice versa. Many traders are technicians. They rely tremendously on indicators, and they can't do anything until each and every indicator is totally aligned, it crosses over, or everything is perfectly in tune with each other. That's your signal. All the bells and whistles go off. That's your signal to enter into a trade. Probably the most popular and the most used form of entry in a trade is fundamental news. There are so many traders that rely on news in order to do anything. They cannot make a decision unless they see what the economic report is, or the what's going on around the world, or what's being announced that day, some report, or what's going on with earnings. They must rely and see what that news is before they decide to jump in the water. And then lastly, a lot of traders really just listen to TV commentators or the so-called pundits, and if they're saying that they like a stock or they like a particular forex market, they do exactly what they do or what they say or what they're advertising. So these are the main reasons why people will enter into a trade. The only problem we see with this at specialist trading is that you're taking your signal off of an outside source. In other words, it's coming from something that's not really the basic structure of what you're trading. You should be taking your signals from the chart rather than from an outside source. And by the chart, I mean just what you see right in front of you, not an indicator or not some trading room or chat room or not some fundamental news, but just off of the bar charts that you're seeing in front of you. So, how do we take our signals? What's this entry technique? Well, we call this the confirmation method. And basically, here's what you want to do. If you get a signal in any strategy, or if you have these three components that we've talked about that come into play, what you want to do is, if it is a buy signal, you only want to buy once price trades one tick above the previous bar's high. Okay, so that's your confirmation that it's going higher. And if you're going short, if you see these things set up perfectly and all the requirements are met, and you want to go short, don't just simply sell at the market or place a limit order. Wait for confirmation. And what is confirmation to go short? You're only going to sell once price trades one tick below the previous bar's low. That's it. So if we look back at those examples we talked about earlier, such as Facebook here, we see that we didn't just simply buy at the market when we saw all three components come into play. We waited for price to trade one tick above in order to go long, which it did on the very next bar. Same thing right here. And when we went short, we didn't just sell at the market. We waited for confirmation that it traded below the previous bar's low. Same thing with the E-mini. It wasn't just enough to say, well, we have a bar closed in the bottom 25% as it did here. I'm going to sell, because look what would have happened on the next bar. You would have lost a couple of points and most likely, sold yourself out or just thrown in the towel and taken a small loss. What we want to do is wait for that 25% bar and then sell once we trade one tick below. That's our confirmation that most likely we're going lower. Same thing transferred over easily into the forex markets and the dollar yen. We didn't just say, well, we'll buy at the market. We waited for confirmation, meaning that we wanted to see price trade 1 to 3 pips above the previous bar's high. Now, a lot of traders, especially beginning traders or specialist trading, will say, well, Steve, I'm missing a lot of trades, or I get it at a much higher price. I don't get it at the best price because I have to wait for it to trade higher, and it feels kind of strange or kind of weird paying up for a price when I could have purchased it much lower, where the trade would have been much more inexpensive and I would have made a lot more money. That is true sometimes, but remember, the confirmation method is not designed to get you in at the bottom or get you short at the top. It's designed to confirm, that's why we call it the confirmation method, to confirm that whatever you're trading is most likely headed in your direction. Remember, we want this consistency, and that's how you get it in your trading. Let me show you an example here in AIG. All right? As you can see, we are above the 50-period simple moving average, so that requirement is met. Then we start to see price sell off, okay? So that requirement is met. Now we want to see a price bar close in the top 25% of its range. Well, there we are right here. So this looks perfectly set up to all the three things you must have in order to have a successful strategy in every trade signal. But the only thing is, most beginning students will say, well, this is great, I'm going to buy at the market. But remember, we want to use our confirmation method, meaning that we'll only buy if we trade above that. And had you just simply bought at the market, look what would have happened. You would have probably stopped yourself out and said, well, it's not going to work out, I'll sell. Excuse me. Or perhaps you would have said, well, it still looks okay. Actually, we're not really selling off that much. And guess what? There's another bar here that closes in the top 25%. So maybe I'll buy more. I'll double up my position and I'll just buy more. But as students of specialist trading, we will only buy if it trades, once again, above that bar. And as you can see, it never did again. So had you purchased at the market or placed a limit order to buy at the close or a little bit lower, you would have been long this stock, AIG, and you still wouldn't have had a profit. Now, we have one more chance to get long. As you see here, we've still sold off. We had a couple of bars close below the 50, but now we have a bar that closes above. So this is actually okay. It's perfectly admissible to use this example, and we close in the top 25%. So most beginning students, or students that really aren't accustomed to being disciplined by using the confirmation method, would simply buy at the market and they say, I'm tripling down. It didn't work the first two times, but I know this stock's going to take off. But those seasoned pros of specialist trading said, no, we'll buy it, but we'll only buy if we trade above. So as you can see, we never traded above in all three of those examples. So over time, it's best to use the confirmation method. Sure, from now and then you'll see examples where you wished you would have just purchased at the market because you would have had a much better price. But it's examples like this where you'll give back everything you made by not using the confirmation method. Remember, we want to have our trade being consistent. We're not concerned with home runs, and that mentality is built around trying to buy at the bottom and sell at the top. At specialist trading, we're not concerned with buying at the bottom or selling at the top. We're just concerned with finding the trend and then jumping on board. That's it. All right, so let's review here. Remember, included in every trade signal, if you're going long, you want to see price above the 50. You want to see then price decline towards that 50-period simple moving average. And then you want to see a price bar that closes in the top 25% of its range. You want to see all these things in place if you have a buy signal, regardless of what strategy you're using, if it's one of mine or something you made up or something from another educator. But included in that, once you go long, you don't want to buy at the market. You only want to buy one tick above the previous bar's high. That's the setup bar's high. And this works just as well if you're going short. We want to see price below the 50-period simple moving average. We want to now see price bounce or rise towards the 50, and then we look for a price bar that closes this time in the bottom 25%. If we have all these conditions in our trade signal, then we only want to go short once we see price trade one tick below the previous bar's low. These are the four things that you really want to see in each and every trade signal. That's why we broke this up into two separate videos and two separate video lessons, because we really want you to understand these concepts. These concepts are included in each and every one of our strategies. We have upwards of 10 strategies for each different market, and each one of them includes these components. As we stated at the very beginning of this presentation and last week's presentation, most traders want to achieve success, and they think success is about hitting home runs or making as much money as you can, as possibly as fast as you can. Remember, success is about consistency. Success is 2 steps forward, 1 step back. Consistency in your P&L, so you have this nice upward slope in your equity graph, and consistency will have you trading 20, 30, 40 years down the road. How do we get that consistency? Through keeping your trading as simple as possible. The road to success is paved in simplicity. This concludes this week's stock E-mini and Forex lesson. Remember what you must include in each and every trade signal. We suggest that you really study and learn all these different components. The best way to do that is by watching this video over and over. And then if you are members of Specialist Trading, we encourage you to become members and learn all of our different strategies and then paper trade them. That's how you will get to that road to consistency. That's how you will be able to trade 20, 30, 40 years down the road. In conclusion, I ask that you take one last look at our disclaimer. We showed you some performance results using these details and these components in your trade signals, but please remember that we can in no way guarantee that any of these results will be repeated in the future. Thank you so much for attending these videos. We'll see you next time. Bye-bye.